In this market update, I'm going to give an update on the THOR indicators. Hi, Jim Gore from THOR Wealth Management here in snowy Cincinnati. It's that time of year to do our year-end review of what our THOR indicators are showing us today. Let's first look at the THORdex, which is looking at the U.S. stock market. And if you look at this indicator, it has remained up here for some time. It is at 74, which means that it is elevated. As you can see by the performance numbers, it's 28% of the time the indicator, the THORdex, is at this level. And every time that we're at this level, the average annual rate of return over the next 10 years for the stock market is 5.79%. So it is saying that the market is rich, but it isn't as rich as it used to be back in 1999 or more recently a few years ago when it was over 80. But the market is expensive. This is our indicator. This is something that we look at and we produce ourselves. But there are other indicators that are saying that the market is at even more extremes. And let me show you that. One is the Buffett indicator. And this is where he's looking at the valuation of the stock market compared to GDP. And you can see right now that the stock market is extremely expensive. And this is not an indicator that is part of our THORdex. This is not something that we look at, but it is just showing another indicator. And some other indicators are showing that we are at an extreme valuation for the U.S. stock market. And this is really showing you here that it is more extreme than it was even back in 1999, beginning of 2000, right before we saw a technology correction. So the market here, and this is part of the reason why, we're seeing Berkshire Hathaway, selling off Apple shares and raising cash, is because this indicator is showing to them that the stock market is expensive. And that's what the THORdex is saying as well. It hasn't come down. Another thing that we like to look at is on the fixed income side. And there's not much change here, maybe a little bit movement in duration. Two indicators we look at. Are we going to go for credit, which means high yield bonds? Are we going to take that risk that we may not get paid back for making those loans? Or duration? Are we going to be in 1-year notes or are we going to be in 10-year, 20-year notes? And actually, credit still remains negative. It is something that you don't want to invest in, and we really do not like private credit whatsoever because there's a lot of things that we believe are hidden there because these things are unpriced because you can't really trade them. And when that cracks, all of a sudden when you try to trade them, their prices are going to come down in a meaningful fashion. The other thing is duration. Duration has extended itself, and if you are getting paid. You are getting paid now in fixed income. You were getting fixed. You weren't getting an income 3-4 years ago, but now you are getting a fixed income rate, which is very good. And then one of the other indicators that we look at is equities compared to fixed income. Keep in mind, the THORdex is saying the average rate of return on the stock market is going to be 5.79%. You're getting close to a 5% rate of return on treasuries. So you're getting just a little bit less on the treasuries. Well, but you're taking a lot more risk on the equity market. So our indicators right now are saying that fixed income is more attractive than equity at this juncture. And it's why we even have part of our equity portfolios, except for our best ideas, which are always invested in equities, in fixed income at this juncture. If you have any questions or concerns, as always, reach out to us at THORwealthmanagement.com or give us a call. We'd love to help you with your investments if you need that help. Take care and talk to you in a couple of weeks. Subscribe to the THOR channel today.